Okay, so now let's talk about some efficiency and welfare concepts. So we are in our earlier videos, we already defined what we mean by consumer surplus. Consumer surplus is basically the area between the price line and the consumer's Marshallian demand function, right? Well, what about the market environment? If we think of a market demand curve, right? So here is the quantity demanded or supplied, here is the price. So the market demand curve is, let's say, something like this. So this is quantity demand. Well, if this is the market price in a perfectly competitive market, well, this is not an individual, one individual's demand curve, right? This is the market demand curve. But nevertheless, we can aggregate the consumers, all the consumer surpluses at that price, which basically means this area. The area between the demand curve and the price line will always going to give us the consumer surplus. Well, what about the producers? Well, similarly and symmetrically, when we have quantity versus P graph and a supply curve, let's assume it's an increasing function, all right? We're assuming that these are long-run supply curves. So for any given price, okay, how we measure the producer surplus is basically the area between the price line and the supply curve. So this triangle is going to measure the producer surplus. Well, I'm not going into the details of producer and the consumer surpluses because this is something you already learn in principles and intermediate micro. What I want to say, at least underline, is that a perfectly competitive market outcome is the outcome that maximizes total surplus. Well, what is total surplus? The total surplus is basically a summation of consumer and producer surpluses, all right? So the total surplus is equal to consumer surplus plus producer surplus, right? I mean, in this market, there are two players. You're either consumer or producer. Well, obviously, the government can play an important role, for example, by imposing tax. Let's ignore the government for now, because in a perfectly competitive market, we know that unless the government has a specific intervention, the government does not influence the market price. And so, therefore, if there's a total surplus, it's going to be divided between consumer and the producer. Well, the total surplus is maximized at perfectly competitive market price and output. Graphically, that basically means the following. So this is Q versus P graph. Let's suppose this is the demand curve. Let's suppose this is the supply curve, all right? And so perfectly competitive market quantity is this, and perfectly competitive market price is this, where the supply and the demand are equal. And if you, if you apply this idea of consumer surplus is basically this triangle, all right, this is consumer surplus, and the producer surplus is this lower triangle, and so the total surplus is this big triangle. This is A, this is B, this is C. So therefore, the total surplus is A, B, C triangle. The consumer surplus is APB triangle, and the producer surplus is CPB. All right? Well, it is maximized, the total surplus is maximized if at the perfectly competitive market price. So graphically, how can we make sure of this? Well, kind of simple. So again, drove the demand and the supply curve. And let's suppose the market price is this P, all right? It's different than the perfectly competitive, it's higher than the perfectly competitive market price. Well, let's calculate the consumer and producer surplus now. Well, be careful, if this is the price, because it's high, the total quantity demanded is going to be this much, all right? We don't have more, normally the quantity demanded will be this much, but now we're going to have less quantity demanded because the price is higher. All right, well, if we calculate the consumer surplus, obviously it's this area. All right, the consumer surplus. Because all these customers in between here and here, they are now not able to buy this product because the good is way too high for them. Well, what about the producer surplus? Some people, some students, unfortunately assume that this is going to be the quantity supplied. And so they say, you know what, this is the producer surplus. No, this is not true. Why not? Well, the problem here is, at this price, exactly true, this is the quantity that the sellers would like to produce. However, if they produce this much, that doesn't mean that they're going to be able to sell all their outputs, right? Because there is less demand. There's going to be excess supply. And excess supply means basically you are producing a bunch of items and you can't sell them. So that means loss, in fact. So you can get revenue only out of the products that you sold. So that means I would like to make things, all right, better without erasing the entire graph. So that means if this is the price, yes, it's true, this is the, the quantity firms would like to supply. However, the demand curve will determine how much product will be sold. Meaning only those sellers, or this many sellers can sell their products. The rest cannot sell it. Think it this way. So, which means the area between the price line and the supply curve, but it's kind of cut short for those producers because they can produce, they are willing to produce, but they know that they cannot sell those products. And so if they produce, they're going to make loss. And so they're not going to produce it. So therefore, this area is going to be the producer surplus. And hence, by definition, total surplus is consumer surplus plus producer surplus. As you see, this shaded area is clearly less than this ABC triangle. All right. We have this small triangle. I'm going to color it with red. So this red triangle, which basically goes to no one. We call this, as you remember, deadweight loss, or DWL. My intuition, you can think of this as follows. The market supply and the demand curve is actually represent how big a pie this market gives to its customers and its producers. So this triangle here, maybe it's better, ABC, is basically representing the total size of this pie, which can be shared between the consumers and the producers. While the price basically determines how they are going to share this pie. So here, the perfectly competitive equilibrium price is a very thin knife that you can divide the cake here it looks like equal. Obviously, it doesn't have to be equal. It depends on the demand and supply curve's elasticity. For example, if we have a very, very inelastic supply of demand curve, but if we have some sort of very elastic demand curve, you see what I mean? So here, this is the equilibrium price. As you see, the consumer surplus is much larger than the producer surplus. So this cake is not going to be divided equally. It depends on the relative elasticity of supply and demand curves. But my point is, the perfectly competitive equilibrium price is a very sharp, very thin knife where you can sort of divide this cake without wasting any piece. However, any other price is like a very rough, very thick knife. When you want to sort of cut this cake, unfortunately, you're going to waste some part of it. All right, and so this red area is basically the area where you're wasting this cake. It's not gonna be able to consumed by the consumers or by the producers. Nobody is actually benefiting from this area, this cake. It's wasted, and so it's a loss. We call it deadweight loss. And once again, the perfectly competitive market actually maximizes the total surplus, and any other price is causing inefficiency. All right, so that means if total surplus is maximized, it's the efficient outcome. Any other outcome is inefficient. All right. Well, the question is it possible that the market price is going to be different than perfectly competitive equilibrium price? Yes, of course it is possible. How so? Well, the government may intervene and change the market price, right? For example, I know you guys talked about all this in much detail in principles and intermediate micro, so I will just briefly mention how it influences, but let's sort of think of international trade example. All right, so let's try to talk about a very simple example, an international trade example. So consider a country where they produce this product. Let's suppose it's olive oil, and this is the supply, the domestic supply for olive oil, and this is the domestic demand for olive oil. And so let's assume that this country is not making any trade with olive oil. For some reason, government banned export or import of olive oil. And so this is P star is the perfectly competitive market price. And this much consumer can enjoy olive oil. So let's call it Q star. And this upper triangle is the consumer surplus before the trade. And this lower triangle is the producer surplus before the trade. So now, for some reason, let's say government decided to open its border for and allowed oil trade, all right, olive oil trade. And let's suppose that the world price, is less than P star, all right? Well, let's suppose Spain and Italy or Greece, they can produce olive oil at a much less cost. And so the world price is actually much less than P star. So what does that mean? Once the government allows international trade, they are now facing two different price, right? Domestic price P star and international price P world. Well, but the thing is, obviously, here, of course, we have the assumption that the trade has no barrier or has no transaction cost. Obviously, shipping, for example, if this country is Canada, shipping all the olive oil from Spain or Italy to Canada is a costly transaction, right? You have to ship them over, and that means a lot of money. But let's suppose for some reason, for simplicity, this transaction cost is either zero or very, very minor or small. So in this case, what's going to happen? The consumers and sort of the producers maybe are going to say, well, why am I producing at this price? There's going to be a bunch of new traders who are going to buy the olive oil from Italy and then bring it to Canada. They're not going to produce olive oil, but they're going to sell olive oil, right? Or let's suppose the buyers can online order olive oil from Amazon, Italy, and then it ships all the way to Canada. And so that means this market is actually going to face this new price. Let's call it the world price. All right, so that's going to be the new price for this market. What does that mean? That means at that new price, obviously there is going to be a lot more. So here is how much quantity demanded. All right. So this is going to be a lot more customers who can enjoy olive oil because it's cheaper. So what happens is that this is what the new consumer surplus will be, this red area. All right? Well, what about the producer surplus? Well, here, remember, we do not care about international producers. We do care about domestic consumers and domestic producers. Well, here, the domestic producers are going to be produce and sell only this much. So Q supplied by the domestic producers. So therefore, this is going to be what producer surplus is going to be. Well, what happens though, total surplus, equals consumer surplus plus producer surplus. As you see, it's this red area plus this blue area is clearly much bigger than this initial triangle A, B, C, let's say. So this area is greater than the area of ABC triangle. And so what happens, total surplus has increased. So that's a good news. So when the international price, the world price is lower than your market price, it's a perfect news. Very good. Well, let's consider the opposite case. Meaning, let's assume now that so this is, by the way, you become an importing country, right? You import products from other countries to your country. So now again, Q versus P, I have the demand curve, I have the supply curve, and so this is the market, the equilibrium market price P star. And so let's assume that what happens is the world price is this time greater than the P star. Well, what is this? Well, let's say the Canada is producing maple syrup, and so the world price was much higher than the price, the domestic price. So once the Canada opens its border and allows free trade, import or export, what's going to happen? So remember, this is the P world. So this country is going to able to, well, the sellers are going to say, hey, you know what? Why am I selling my product at lower price? Instead of selling Canadians at a price P star, I actually prefer to sell to my international customers at a much higher price and make more profit, right? So therefore, once this country opens its borders for international trade, well, the market price is going to be higher than the P star level. Well, is this going to influence the consumer and producer surplus? Yes, it does. How so? Well, here, remember, this is Q supplied. By who? By the domestic suppliers, because they're not only selling to domestic customers, but they're also selling to international customers. So at this price, this many producer would like to produce this good. This is, however, quantity demanded by the domestic customers. So they are facing higher price, so therefore less customers are willing to buy this good. What happens is that the consumer surplus will shrink relative to no trade case, but the producer surplus, let me use the red. So the producer surplus is actually increases. And so nevertheless, when you calculate the total surplus, it's still going to be greater than ABC area. So in this very simple environment, what we can say, if a country opens its borders to international trade, whether its domestic price is higher or lower than the world price, well, the total surplus will increase. Well, obviously, in this case, consumers will get worse off, but the producers will get better off. All right? In the previous scenario, the consumers were better off, but the producers were worse off. But nevertheless, international trade is going to benefit the entire economy. Well, obviously, this is a very simple scenario. International trade may have sort of other side effects, and so the picture is not that clear, obviously. But this is just one example how a government, for example, can change the structure of the or the distribution of the total surplus. Okay?